everyone. Thank you for joining today. As Penny said, my name is James Chaplin, so Senior Manager of the Curve Trading team here at EDF in the UK. And format of this webinar, same as usual, we're going to be focusing on really what's happened over the last 3 to 4 months. So from the start of April, have a look in kind of the price movements in both kind of gas, carbon, how that's impacted the power pricing. Touch on some of the fundamentals, the geopolitics that have happened, and then have a quick look kind of to the future, see kind of what risks, potential volatility there is ahead. And as Penny said, if there are any questions, feel free to ask in the Q&A. Obviously, I'm not going to go into detail about all the topics you might like on kind of renewables impact the market, etc. So if you did want to ask any questions, that feel free. We'll try to answer as many as possible at the end of the webinar. So, as usual, I'll just start by looking at a picture of the winter 25 MBP, so UK gas price, and see most of the volatility we've seen in the market that's impacting power prices has come from the gas markets. We've been focusing a lot kind of on the gas volatility we've seen over this time, briefly on the carbon as well. So this is kind of how the price has developed from the start of April. Obviously Q1, I won't go into detail about, but heavy volatility there, mainly kind of on the fundamental side where we thought, it was kind of really tight market up until mid-February. And then we got a bit of relaxation in kind of EU storage targets and very kind of mild weather towards the back end of February and into March. We kind of eased a lot of the tightness concerns. Over the last 3.5 months or so, that volatility has still been prevalent. Again, we're going to be talking a lot about the geopolitics here, but you can see on this chart kind of bottoming out around mid or late April, around 88 pence per therm, and topping at 110 pence per therm. Currently pricing towards the low range kind of over this period at around 90.8. I think actually this morning is trading just around 90p or so. So just to call out some of the key things that have impacted lots of the volatility. Now we'll cast our mind back to the beginning of April, and we had Liberation Day. So US tariff announcements. This impacted global demand forecasts. Everyone's worried about recession fears. Essentially, that just means less gas demand expectations, same supply forecast, and obviously then quite bearish to pricing. So freeing up more LNG for the global market. At the same time, we also had a weaker fundamental picture. As I said, we had quite mild weather over March. April, people are also concerned about late cold snaps, potentially flipping gas storage still into kind of withdrawal mode, kind of in early summer. That didn't happen. It was still quite mild forecast throughout April. So not only did you have potential recession fears and demand fears, you had weaker fundamentals than we thought we had in the risks a bit earlier. So quite a bearish picture towards the start of April. Prices then stabilized a bit, and then another dip. This is kind of where we bottomed out over this kind of period towards the back end of April here. Now, a couple of things. So you still had the weaker fundamentals on mild weather. So you really got to the end of April, and that's when kind of cold risk kind of stops. You didn't have any cold then, so that was all kind of fine. So that risk kind of got priced out the market. But on the geopolitical front, you had escalation between the US and China on trade wars, over 100% tariffs getting thrown around in kind of social media, tweets, etc. But also you had I suppose the highest hopes of a Russia-Ukraine peace agreement as well. So that's, I think, when the first talks between the two countries were organized, and really higher hopes of further gas supply from Russia re-entering the market. So the supply that has been sanctioned over the past few years by the US returning to the market. Obviously, those hopes are a lot less now. So that kind of hope and that bearishness has come out of the market, and we've still got some headlines on tariff coming out as well. We then go into May, and kind of the market remained fairly kind of quiet, subdued through this time. You had kind of weaker fundamentals at the time from obviously that mild spring we just talked about, and still continued low Asian LNG demand. Typically, we expect Asian LNG demand to start picking up around kind of early May time. It was a bit later this year, so that's why the market was a little weaker during that time. And obviously concerns around kind of cooling season upcoming. A bit of volatility kind of towards the back end of May. So this is small changes to Norwegian gas outages, and then occasionally some kind of headlines on Russia-Ukraine peace. But really, what I wanted to call this point out for is any kind of small supply side changes here in Norway, and it wasn't drastic kind of outage plan changes. It drove quite substantial volatility, um, which I suppose it kind of sets the scene of the market we're in at the moment. When we're in a period of calm, it is still a very sensitive market. It only takes small changes in kind of supply demand expectations and risks to cause that volatility. So it's very much still the place we're in, and probably will be in over the next couple of months. Anything that's going against the normal expectations, causing bigger price uplifts or downlifts. Obviously, if we get into June, geopolitics taking the headlines again. So Middle East conflict between Israel and Iran. So two main things kind of impacting UK power and gas pricing. First of all, Israel shutting down their gas fields. So obviously this is due to kind of safety risks. Israel typically are an exporter of gas to Jordan. Obviously, with the shutting of these fields, if that was an extended period of time, some flows are going to have to be readjusted. Jordan's going to have to import some gas from Egypt. Egypt's going to have to supplement that by going to the global LNG market, and therefore taking some of that LNG away from Europe towards Egypt, and kind of tightening the picture there. The more kind of threatening, I suppose, thing for prices was the Strait of Hormuz potentially being shut. So Iran, I think they passed kind of the law or so to shut the Strait of Hormuz, which they never did. This would have been potentially another energy crisis. So obviously we got up to just over 110 pence per therm through this time. If the Strait of Hormuz was shut, this would have gone way higher, because of, I think, around 25-30% of global oil flows go through that passageway, and about 20-25% of global LNG flows as well. So if that happened, and if it was for a prolonged period of time, you would have had much higher prices. So this was really the market trying to price in that risk. It was still low risk, but you've got to price higher during that time, as kind of the conflict heated up a bit. Thankfully, we had a quick turnaround, quick ceasefire after the US strikes of Iranian nuclear facilities. So obviously hostilities kind of stuck. The ceasefire has held, thankfully, and all that risk premium came out of prices, and that's where probably the market oversold a little bit towards the back end of June, kind of getting again below that 90 pence per therm level. But yeah, really kind of all that risk premium on Middle East, kind of potential of Strait of Hormuz shutting came out the market. Israel production facilities again came back online. Now, this story is very much not being priced into the market at the moment. It's obviously gone quiet. We're not really expecting too much risk here. But again, it's just something to obviously keep in mind, where the asymmetric risk, if escalations did kind of boil over, it is very much asymmetric to the upside. But again, very low chance the market's not pricing in that at all currently. And then more recently, a couple of weeks ago, saw a little high of almost about 98 pence per therm. Now this is kind of pivoting back towards Russia, Ukraine. So Trump had a big announcement on the Monday of that week, where he was threatening further US sanctions on Russia, and that'll be targeting their energy facilities. So probably mainly oil, but also targeting gas as well. We didn't know kind of the scale. It was very much up to himself to decide what facilities he would target, and kind of the level of tariffs, or how hard he'd go in on Russia on there. The news of the 50-day deadline disappointed the market, really. So that kind of risk premium that previously built up has subsequently come out the market through that time as well. And that is where we are at the moment. Obviously, fundamentally, we are still fairly low gas storage stocks, which we see at the moment. So we've got a good bit of refilling to do over the next few months, but there's still very much geopolitical risks on the cards, both from tariffs, from sanctions, and probably less so kind of Middle East at the moment. On top of that, so obviously, as we said, gas has been the main contributor to volatility in UK power prices. Another key contributor is the carbon price. So if you still think gas generation still predominantly sets the price of power in the UK, UK carbon price is another kind of key contributor here. So I don't have any call outs in this one, but this just looking at the DEC 25, so the front December UK carbon price from the start of this year up until now. Now, the UK carbon market by itself is fundamentally oversupplied at the moment from the regulations, really driven kind of just from the supply the government's kind of putting into the scheme or kind of set out in the scheme at the moment. The demand's just not there. That's why prices were very depressed towards the start of the year, trading down to almost as low as £30 per tonne. As you can see, prices have ramped up quite a lot through the year. Now, there are kind of signs of, there is going to be tightening in the scheme towards the back end of the decade, and that's really so government can hit its, get a bit closer to their clean power 2030 targets. But I suppose the biggest news story kind of started to get priced in a bit earlier in the year. There's EU summit where it kind of got confirmed in May, and then some more recent news as well is about linking the UK and the European carbon markets. Now, linking the two would essentially mean price parity. So both prices should trade at the same level. It includes the UK into a larger carbon market. Liquidity should be better, etc. as well. European carbon market isn't oversupplied as the UK market is at the moment, and has been trading much higher through the year. So the difference between the two schemes back at the start of 2025 was around 30 to 35 pounds per tonne. So European prices 30 to 35 pounds per tonne higher, so pretty much double. Now, with news of potential linkage, that delta has come into between 10 and 12 pounds. So UK carbon still trading at quite a big discount to European carbon because there's uncertainty when and if this linkage will happen, but it definitely does seem some movement is happening there. And I think there's a vote between EU countries coming in September, so that could get a bit more positive in that regard. Probably still a couple of years off, but if you do get any positive news on linking the two schemes, outside of kind of the outright fundamentals of potentially we could see overall carbon prices increase towards the back end of the decade, you're going to see that spread potentially narrow as well. So the £12 discount the UK is currently at could narrow. Obviously, if talks break down, it will go the other way, but it does seem some positive comments have come out more recently on that. And I suppose just to put into context, a £1 per tonne move in the carbon price, depending kind of what, if you're looking at a summer or a winter kind of UK power season, can have between a 25 to 35 pence per megawatt hour impact in the UK power price. So on to fundamentals. So European gas storage, obviously we're tracking this to kind of see where we are with kind of global balances, forecasting kind of where we're going to get to. So this is just showing obviously injections through the summer. So starting in April, we get to quite full capacity, and then when we withdraw. So focus on that black line we've seen previously. We were very full going into last winter. Some obviously less comfortable kind of supply demand scenarios than previous winters. We withdrew quite heavily, particularly kind of over that January period where we saw quite cold weather. Ended winter within the range, but quite low considering we don't have that stable kind of Russian pipeline supply anymore. We rely much more heavily on the global LNG market, and you've got to obviously have a higher price to kind of pay to get that supply. So we had a bit of a task to refill for this summer. So you can see we've made very good progress so far, but we've still got quite a long way to go. So again, I suppose much better place than we forecast we were going to be in. Hopefully should get to between 80 to 85, maybe slightly above percentage full prior to winter, but we're still susceptible to any kind of tightening of supply over the next few months, Asian cooling season, US hurricanes, etc. Next, so temperatures. So I think I've already alluded to it. We, very kind of mild temperatures, kind of March and April. If I just kind of focus on those 2 months, looking at, UK, Germany, France here, and this is kind of delta to seasonal normal. you can see that through these 2 months, particularly on the continent, very mild temperatures. And I suppose to put this into context, if we saw seasonal normal through this time instead of that mild weather, we could have withdrawn an extra up to 100 terawatt hours from storage, and it would have meant we would have been in a way worse position now and probably much, much elevated prices. So thankfully we had, quite a mild kind of shoulder months to end the winter and put us in a much better position than we thought we were going to be in back in kind of February time. On the supply side, so again, we've seen on the demand side, we got quite lucky in kind of March, April time. On the supply side, it's been better as well. So this is kind of roughly what we expected, probably a bit better than what we expected. But 8 BCM more LNG into Europe over Q2 2025 versus the same period the year before. Now, part of this, or big part of this, will be just a general ramp up in supply from the US. So Plaquemines, it's big, the big facility that's come online early this year. But also that lower Asian LNG demand as well than expected has helped more supply come towards Europe. So that kind of milder temperatures reduced demand, but also that extra supply helped us refill storage to where we are now. But we just need this to continue over the next few months to get to a comfortable position ahead of winter, but we're still going to be susceptible to kind of any geopolitical changes through that time. Now, I think this is probably the same slide I had in the last webinar. It's kind of just to more talk through it. Actually, I'll bring up kind of all the points at once here. But yeah, a few things kind of we're monitoring at the moment. So obviously, we know we've got a good chunk of LNG capacity coming online later this year, over the next few years as well, potentially mainly kind of from the US and Qatar. I suppose, obviously that's good in the longer term picture. So when you get to 2027 or so, but there are risks at the moment of project delays, particularly in the Qatari projects where they could be delayed, 3 to 6 months. And obviously that kind of takes out the balance of what we expect to start 2026. So those delays definitely still remain kind of one of the key risks to monitor there. Asian cooling season. So, we're height of the Asian cooling season at the moment. There's still risk of heightened demand over the next month or so. So again, just have to watch that. I suppose what I haven't added on here on the fundamental side is hurricanes as well. So we're in kind of approaching the peak of the US hurricane season. That's where a lot of the LNG liquefaction facilities are as well. So if a hurricane gets close or kind of nearby hits one of those facilities, it could take that supply offline for a period of time. And we are also upcoming to some outages both in Australia and Norway over the next month or two. Geopolitically, so US sanctions, I think last time the focus was, there was high hopes for a peace deal. There could be a relaxation on sanctions and therefore Russian gas returning to the market. I suppose it's kind of flipped now where we're a bit more concerned of further sanctions and therefore upside risk to pricing after this 50-day deadline. So that takes us to at the very beginning of September. And I think it's anybody's guess of what Trump is going to do in that space and how much it could impact our markets, which we look at gas and power. So something to monitor. I think it's we'll have to kind of see how the story develops. But yeah, that 50-day deadline takes us to right at the beginning, the 2nd or 3rd of September, I believe. And lastly, US tariffs. Obviously, that was a big bearish impact back in kind of beginning and end of April. I think the story now is you're seeing a lot more deals get over the line, or Trump's giving kind of deadlines at the moment. They're getting extended, but some big deals getting done. I think more recently with Japan, there's some positivity around EU trade deal as well, and the deadline with China is getting extended. So potential some positivity there, which could boost or kind of remove the concerns around demand, and then boost the outlook there. So maybe slightly bullish, but again, have to see how those kind of stories develop. So just to summarize, I mean, lots going on, both kind of fundamentally and I suppose particularly geopolitically. So say is roughly calm markets for now over July. We've got through to over halfway through summer. We've been able to fill storage to a very good level. And we got lucky in that kind of the shoulder months in kind of March, April. The supply from LNG has been good. There are still risks both fundamentally, and so that's from the Asian cooling demand, US hurricanes, Australian, Norwegian gas outages, plus typical kind of supply demand dynamics. But there's also big concerns around geopolitical kind of movements as well. So as we talked about, US tariffs, potential deals, but I suppose, more importantly, the kind of the sanctions bill from the US. How hard and kind of if they will implement that. I'm sure there'll be headlines that will drive volatility over the next month. But lots to watch out for in the run up to winter. And I suppose it's always a very important time, particularly through August and September ahead of winter. You still don't know what the winter fundamentals are going to be like. If we're going to get an early cold snap, or if it's going to be like we've seen the last year or two, fairly mild start to the winter. A bit longer term, so kind of down the bottom here. So Russia-Ukraine peace deal, I suppose, remains one of the biggest bearish risks to prices in the market. Obviously, relaxations of US sanctions on Russia. It does seem very low probability, obviously, with how the talks are going at the moment. I think the latest Russia-Ukraine talks last night, they lasted just 35 minutes. So you probably put a very low probability on this, at least in the short term, but definitely one to watch over the next year or so. And lastly, LNG supply. So we know all this is coming online over the next few years, ramping up into 2027. Potentially could ease tightness concerns. I suppose it's still very much going to be dependent on what happens this winter and kind of weather fundamentals. But also one of the big uncertainties, when the supply comes online in a couple of years or so, is AI data centers as well. What's the demand side going to be like and change over that time? There's a big drive in very, very large scale data centers, both in the US, China, and around the world. Is that going to obviously suck up some of this LNG supply coming online? And obviously we still have all the risks around, are these projects going to deliver on time? But yeah, for now, it's very much kind of focusing on geopolitical and fundamental risks and how they play out over the next couple of months before winter. That's all from me. And open up to any questions.
Thanks, James. You've had a couple come through already, so I'll begin. I think this one you have touched on already, so I don't know if there's anything to elaborate on. But just to say, in the news, Trump has announced today he's going to put 100%. I believe it means tariffs onto Russia. Anyone that uses them, and will that have an impact on pricing?
Yeah. So this is the 50-day deadline, the 100% tariffs. So we thought it was going to be implemented more immediately. Back it was a couple of weeks ago, but he's given them 50 days to try to end the war in Ukraine as a kind of a negotiating tactic, I suppose. As we say, is anyone's guess of what he's going to do when that 50 days hits. If he does go ahead with the sanctions and they are 100% and they impact both oil and gas, yeah, I mean that is a big risk to prices in our market, and I think that's going to be one of the key things everyone's going to be on the lookout for over the next few weeks, and that risk might ramp up towards the end of that 50 days. But yeah, very uncertain at the moment, and I think we knew this when he took office. It wasn't going to be transparent on what he plans to do. But yeah, if I suppose he's running out of options, keeps threatening sanctions and tariffs on Russia. But yeah, definitely a bullish risk if he pulls the trigger and goes ahead there, and if it's targeting gas and not just oil.
Thank you. So I guess it's definitely worth signing up to your next one, which is about October, isn't it? So it'll be after that, and there'll be more news on that subject then. Thank you. So so I'll just go through these in order. So they might relate to different parts of the pack. But what impact does the UK EU reset have on carbon pricing?
Yeah, so that is what we talked about with the carbon linkage. So yeah, that's the biggest impact. If they get to linking the two schemes, then they should trade at parity. So the UK carbon prices should then come up to the European level. and therefore, yeah. So it's, I suppose, watching that, it not expecting a fast process because stuff like this isn't typically fast, but any positive headlines on linking the two schemes, yeah, should kind of bring that to parity. And as I said, UK prices trading at about £12 discount to European price at the moment. But yeah, the vote is in September, I believe, between the EU members to start discussions, and then it might take a number of years after that.
Okay, thanks, James. So what are the risks if this winter turns out colder than average, despite faster than expected EU storage refill?
Yeah, so that is always one of the big risks in winter, right? Is weather, is cold weather. Although the winter just gone was colder than the last previous 2 years, it was still mild at the start of winter, and as we said, very mild at the back end of winter. So yeah, if we do get a cold winter, a first cold winter in a number of years, yeah, it will definitely put that supply demand balance to the test. But I suppose that's always the risk running up to winter. Everyone's always concerned around, are we going to get an early cold snap? Because typically you want to still be injecting into gas storage sites in October. If you do get cold weather there, you'll have to flip to withdrawals maybe 2, 3, 4 weeks earlier than expected, and it does tighten things up. But too early to say in the forecast. I suppose it's going to be too early until we're kind of mid late September to know what those weather forecasts are going to be.
Okay, thanks, James. I'm just going to pull some of our pre-submitted questions out as well here. So thank you everyone for sending those across. So what are your views on the coming seasons?
Yeah, so I mean, I think it will be very much driving off obviously what's going to happen over the next few months, both fundamentally as we talked about around kind of how fast are we going to be able to fill storage ahead of this winter, then kind of cold weather risk going into the winter, but yeah, more importantly, geopolitically. So yeah, definitely some risks in the short term, and then longer term, it's going to be, yeah, I suppose, on the gas side, when's this new LNG capacity going to come online? And are we going to see any demand fluctuations in there from kind of AI data centers? And then on the carbon side, you're going to have that linkage. So it's hard to say. I mean, the market's changing all the time. So I'd say focus on kind of the shorter term fundamentals, kind of risks at the moment. Yeah, it could be a very different market in 2027, but yeah, there's lots of time for things to change, both geopolitically, fundamentally, supply and demand based there.
Thanks, James. So the next one, how can EDF support becoming self-sufficient and independent with also supporting the grid with surplus?
Yeah, so I suppose probably a good question for our policy and regs department. So I think EDF is kind of leader, kind of paving the way to clean power 2030. But yeah, I believe is there a webinar in September, Penny,
There
where
is.
hopefully they'll talk about that a bit more.
Yes, so we have we'll be putting it onto our TalkPower page, but we're going to have an insights into energy and policy webinar in November time. So if please all sign up for that. We had a question submitted regarding REMA, but we've also got our monitor non-energy cost webinar, and that's in September. We'll show you more details on that at the end of the webinar, but you can sign up to both of those to kind of find out a bit more about those two topics. Okay, brilliant. Thank you. So we've had some more come in on the chat. Let's have a look. Are you able to share your thoughts on any risks to the French nuclear fleet given the recent discovery of stress corrosion at Sivar?
No, no, nothing. I mean, all I know is what's been remitted, obviously. So yeah, I can't say any more of what is public information. But yeah, it doesn't seem as big a risk as obviously back in, is it 21 or 22, when there was wide part of the fleet on kind of high risk of corrosion and kind of risk outages. I don't think it's kind of that situation. Maybe 3 units or so. But yeah, it's all just kind of public information is as much as I know.
Okay, thank you. And then I don't sorry, attendee ask, please can you repeat the impact on electricity prices by a rise in carbon prices?
Yeah, so typically, obviously, gas generation is still the setter in UK power pricing for the most part. And carbon for a typical gas generator will have about a 30, £1 per ton impact will have about a 30p per megawatt hour impact to the power price. Now, that will be dependent on how much of the time the market's forecasting gas is going to be running. Obviously, in summer periods where we're seeing negative, very negative clean spark spreads, you're expecting that a lot of the time you don't need gas to run because you have a lot of renewables on the system and kind of much lower pricing. But yeah, typically very ballpark 30 pence per megawatt hour impact from a £1 per ton move. It can be less depending if you're expecting less gas running or just more efficient gas plants running during that time.
Thanks, James. We've had another question come in regarding kind of the US situation. So how might US energy and sanctions policy evolve under Trump's leadership if further actions against Russia are taken?
Sorry, can you repeat that one?
Yeah, sorry. Yeah, so how might US energy and sanctions policy evolve under Trump's leadership if there's further actions against Russia?
I wish I knew. I think that is the key question at the moment. I think the market's going to have to just wait for more details. So I think I've elaborated earlier on the potential risks to the market if he does, go hard on kind of tariffs impacting both oil and gas. How much gas supply does that impact in the market, and is it an immediate impact? As we said, the market is still quite sensitive at the moment to any changes in supply and demand. So yeah, it could have a big impact, but I think everybody in the market's scratching their head thinking, what's he going to do? When's he going to do it? And kind of how harsh is he going to be in implementing and enforcing those sanctions as well? And I suppose on the flip side, if you don't get that, and miraculously you do get a longer term ceasefire or peace, you then have relaxation of other sanctions, although that does seem quite low chance at the moment.
Brilliant, thank you. I think so. That's it on the questions you've had come in. Unless anyone's got a last minute one they want to submit across to us before we finish. No, if not, I guess we'll just redirect you to the TalkPower page to sign up. Like I say, we've got the non-energy cost webinar coming up in September, and then we'll have our policy and regs update. So hopefully any topics that James that don't fit into James's kind of area on the power market updates, we can cover for you in those. But if you do think of any questions once we end the webinar, then please feel free to get in touch at our email address below, and we can kind of pick those up outside of the webinar. But yeah, thank you, James, for your insights as always, and thanks everyone for joining. There will be a bit of feedback questionnaire pop up when you exit the webinar. It'd be great if you could just give us a quick moment to let us know, just so we can always improve or make sure that we're delivering the right content across all our webinars. But yeah, thank you so much, James, and have a good afternoon, everybody.
Thanks all.